Hey guys, welcome back to another video by Fully Informed Trade, or Fitrade for short, knowledge for everyone. My name is Alex Cho, and today I am just going to analyze the broader markets and talk about what's going on. First of all, the US dollar index is having a pretty decent pullback on the session. However, let's take a closer look on the day's action. First of all, the dollar index did pull back in the overnight session, but it's starting to have a decent rally towards the front end of the New York Stock Exchange Open. So this could have a negative impact on equities throughout the day. So just watch this very closely, and we'll just see whether or not the dollar index wants to continue to trade higher, and if it does, it will have a negative impact on stocks, of course, or whether or not the dollar index wants to retry for that, again, 50-day moving average, try to pierce above it. But again, we've stayed consecutively below it for around 4 sessions, and this could be the 5th session, but we'll see if the dollar index really wants to reverse itself. Euro US dollar is also having a pretty decent pullback on the session. Again, the main reason why the US dollar is having a pretty decent run right now has been because the Euro US dollar has been pulling back and consolidating a little bit. But for as long as the Euro US dollar continues to go higher, obviously the US dollar index will continue to fall. Whether or not the US dollar index is the main indicator behind inflation or not is yet to be told, because again, inflation is pretty much a consumer price index, not necessarily the dollar index, which measures the value of the dollar in respect to a basket of other currencies. The thing is, though, is that the US dollar index is primarily measured against the Euro US dollar, which has a 50% weighting. So again, the main point I want to bring out, though, is that this could actually reverse. The US dollar index could actually reverse this trend, mainly because the Euro US dollar has been up for quite a bit of a time, and then it might be able to give back some of those gains. However, I do want to mention, though, that we do have a bullish flag formation starting to form on the Euro US dollar pair, and if that actually breaks out, chances are the US dollar index will have a significant decline again, and that will be able to keep the markets afloat. There has been some reports from various companies. I think it was Credit Suisse. I'm not exactly sure. Barclays. It was between UBS, Credit Suisse, or Barclays Capital. But basically, they're saying that the U.S. dollar index and the stock market indices, that inverse correlation may be coming to an end. But based on what I'm seeing the market's trading more on the Euro US dollar, and the Euro US dollar is primarily impacted by how fiscal monetary programs from the central banks, how they're all playing out. Again, the fundamentals behind all of this is who's inflating their economy the fastest. It still is the USA. Main reason why it's still the USA is because of the lower Federal Reserve discount rate versus the ECB's discount rate. And basically, whoever has the lowest discount rate is most likely going to inflate the economy at a faster rate. Whoever inflates the economy at a faster rate will most likely have the weaker currency pair. And right now, the US dollar should be weak to the euro, and a weaker currency should imply stronger US economics, mainly because of the fact that our exports are supposed to get stronger, whereas imports are going to become more expensive, which should encourage more domestic spending and should curtail any imports or import spending. However, that could be offset just because we import so many Chinese products. So again, whole idea here, the dollar index pair, the dollar index and the stock market correlation could have a hard time keeping itself together. Main reason being is that if in the event this correlation probably will come back together and be more of itself once the Federal Reserve starts to raise their discount rate, which will happen most likely in the year of 2014. Once those discount rates start to rise, chances are the Euro-US dollar pair will start to have a longer-term pullback, and I also believe the European Central Bank will keep their interest rates lower for an even longer and a more prolonged period of time than the US Federal Reserve, mainly because the ECB is running into a secondary recession, and also because of the austerity impacts that's happening on the economy over there as well. So I believe overall Europe is going to have a much longer austerity Federal Reserve fiscal program or fiscal stimulus program for a much longer duration of time than the USA. So we'll see this reversal in trend coming to happen perhaps later on, and once the Euro US dollar does start to pull back perhaps by the year 2014 when the Federal Reserve does in fact raise their interest rates. Then we'll see the stock market trade more in an inverse correlation with the currency markets and the dollar index. So we'll see how it all plays out. The Dow Jones Industrial Average has been on a continuous uptrend. We've seen a lot of factors coming into play over the past couple of years, but most likely the last year in itself. Overall, we ran into an issue back in August, mainly because I think the government was having a hard time agreeing on whether or not they were in fact going to raise the debt limit, so that was the biggest issue. And also we had some issues regarding Europe and whether or not these governments could actually in fact pay back their debt. So we kind of smoothed those two issues over, and right now we're not dealing with a whole lot of problems because Greece has already selectively defaulted on their loans. We haven't seen Italy and Spain rise out of the gutter yet, but again, chances are the European Central Bank will want to keep that contained for as long as possible. And for as far as I'm concerned, I'm pretty sure going forward the European government, or more like the European Central Bank, will even lower their interest rates further. And once those interest rates start to be lowered further to compete with both the U.S. dollar and the U.S. central bank's interest rates, chances are this could also reverse the trend in the Euro-US dollar. Remember, if the Euro-US dollar does reverse in trend, that will cause the dollar index to strengthen, which could have a negative impact on the stock market. Remember, I do believe the inverse correlation is still there. I mean, I might be contradicting myself. It's still there. It's just not as correlated as it used to be. But again, markets are still having a decent float up, perhaps because the U.S. dollar index did have a pretty decent pullback in the nightly session. But right now, the U.S. dollar index, is keeping up and is starting to make back a lot of their losses in the overnight. So again, keep that in mind. Chances are the stock market is still very, very correlated, at least on a day-to-day basis. But if you look at the longer-term trends and the longer-term charts, it doesn't really look that way. So, immediate reactionary response is always to trade based on the U.S. dollar relative to the stock market. But over the longer term, that correlation doesn't hold up as well as you might think it would. Now moving on, I want to talk about the volatility index. Volatility index has had a hard time holding on to its gains. This is the VXX. We've seen a continued erosion in value on the volatility index. And again, this is how leveraged ETFs usually play out. They do lose value for perpetuity. It's just right now we're anticipating some sort of pullback, some sort of correction in the stock market, and perhaps the volatility index is becoming a little more resilient. And I've said this before. If it's becoming a little more resilient, that could be seen as a good thing for the volatility index, because usually a 1 to 2% gain on the stock indices would have sent the volatility index down by anywhere from 5 to 10%. We didn't see that happen, and basically this could imply that people are starting to become more confident in the volatility that is yet to come. Once we get that volatility, once we get a decent flush out in the markets, again, volatility index will most likely continue its downward trend. But why the markets will pull back depends really upon whether or not people are just going to sell because they've already made enough money, partly fear factors, or if it's just because some major event were to happen in the next 2 to 3, 4 weeks, or perhaps people are going to ride the next earnings announcement, which is going to be happening in April through May. Markets might be even willing to ride that, perhaps buy into the earnings, and then right after the major earnings from the Dow components are announced, that's when they'll start selling the stocks. So we'll see exactly when people want to sell their equities, but we're pretty sure that there is some form of correction coming in the near future. It's just not yet identified what's going to cause it, but we're still going to have a pretty decent correction. So we'll just wait and see. Gold market. Gold market has had a pretty rough time. Again, it's below all three of the moving averages, both below the 200, the 50, and the 20-day moving average. We did try to pierce above the 20-day moving average for a bit, but we're having a little bit of trouble. Main reason why the gold market has been able to recover a little bit has to do with the U.S. dollar index. U.S. dollar index has been able to decline for the past couple of weeks, but it hasn't really helped the gold market by much. And I think the main reason why it hasn't really helped the gold market by much has more to do with the fact that perhaps there is less demand for the commodity itself, regardless of however the U.S. dollar index is traded. As you guys can see, we've seen the U.S. dollar index have somewhat of a decent rally throughout the March period. Again, it wasn't much of a rally, but it did have a detrimental impact on the U.S. Or on the gold spot specifically. And whenever the dollar index does pull back a little bit, it does cause the gold market to kind of get a decent float on it, but it's not enough to necessarily reverse the trend or cause some sort of significant incline in prices. Alright, now moving on, same story here with the silver market. Silver market, thing is, strong dollar has a really negative impact on the commodity itself. But when the dollar weakens, the silver market isn't reacting or responding as much. So external factors aren't really improving the silver market or the gold market trade by much. And we're also seeing an overall drop in demand for both the silver and gold coins. Yes, they did improve in the month of March. I'm not as sure exactly what the numbers were, but again, I'm pretty sure people are becoming less and less speculative in the commodity space, as we have seen investors take upon themselves huge losses in the past. And remember, added volatility does detract investors. Moving on, natural gas continues its downward trend, and this is hampering the energy industry. It is hurting energy companies like crazy. Peabody Energy, Consol Energy, Alpha Natural Resources, all sorts of companies that drill for natural gas are feeling the heat, basically because we're seeing margins erode like crazy, but they have no choice but to continue to mine for natural gas. Otherwise, they won't be able to keep up with their earnings forecasts. They won't be able to keep up with the earnings expectations analysts have for them. And if they can't meet those earnings expectations, their stocks will fall. But right now, their stocks are falling anyway. And even though the valuations look pretty good, a lot of people are seeing them as a value trap right now. And I still think natural gas will continue going lower because there's so many people drilling for it, and there's so much competition for it within the space. And therefore, I believe the value of natural gas will continue to go lower, and same with the natural gas companies. Crude oil did have a temporary pullback. Probably has to do with the currency factors a little bit, but again, I still think we're in a long-term uptrend in crude.